So, good afternoon, everybody, on this blistery Sunday afternoon. Thank you for joining and thank you for the invite, Wendy and Faizoa. Always excited to be able to share what we learn. And the number one thing right now has been how do we purchase Strata insurance in BC? So I am Steve Pearce with Seafirst Insurance. I am the commercial insurance sales manager with Seafirst. We've been in the industry about 40 years now and have had a lot of experience with the comings and goings of strata coming in, strata changes, building ownerships just over the years. And in the property side of things, we've been heavily involved with the property capacity available in BC and now starting across Canada in the last few years. So I was asked to present and put some background on the struggles of purchasing, the need of what the roles are of the strata. So the one thing that came about was there's a lot of questions around capacity and how does this affect price and competition, as well as how does environmental influences factor in, as well as what are the best practices for maintenance and risk management to give strata corporations a better chance for coverage. So the one thing to know when you're going through the process of purchasing is that price, capacity, competition all run parallel when it comes to BC and the BC strata market. And the reason being is that price, capacity, and competition all come down to basically these three areas. Yes, there's many words, but they are three areas. They are what is the total insurable value of the common property? What is the earthquake zone and the available aggregate? What is the flood risk? And what is the fire protection and fire risk? And then you come down to the last part is what is the building height, material type, age, building subjectivity, the maintenance, the infrastructure upgrades and liability risks, feeding back to the earthquake zone, the flood risk, the fire protection, as well. What is that value of that building and how it's run? So talking about capacity, there are three basic areas or three basic offerings for property insurance in British Columbia. There is a fourth, but that fourth one is very expensive, and we've seen that. We saw it in the news, and it's called open market. It's when nobody else wants to offer insurance for a risk, and you see very high deductibles, very high rates. And that's because, one, you have to have insurance, especially for people's mortgages and coverages and replacement costs of the building. And of course, because of the Strata Act, you have to provide insurance for it. So when it comes to the many domestic insurance companies, they have very strict criteria and participation in capacity. So in the last 15 plus years, since the Christchurch earthquake, all of the world changed. What was earthquake risk? What was the reinsurance risk? And also, what was their comfort level of providing insurance in these areas that were very risky for an earthquake? So the domestic markets, and what I mean by domestic markets is insurers that land right in and have offices in Canada, the Intacts, the Avivas, the Travelers, the Northbridges, the Zurichs, and it goes on and on. They all have capacity and they have to purchase reinsurance based on what their exposure is. Now they have agreements, each one of these insurers, with specific brokerages, and they're different agreements based on the experience of those brokerages, as well as what volume can those brokerages bring to them. So in the strata market, especially with very big buildings, we're talking multi-level, over 100 to 200 units, uh, total insurable values over 25 million. They used to be very difficult to find capacity. These are the large towers you see in downtown Victoria, downtown Vancouver, obviously bigger in Vancouver. And those domestic markets didn't want to take the full building. They only wanted a portion of it. So this is where number two comes in, which is the Lloyd's markets and cover holders. So there's two descriptions of that. So a Lloyd's market comes as a cover holder, which could be a brokerage that has earned the ability to have the pen, they call it, and they're able to offer capacity to add to what the domestic markets are able to offer up. And then there's the wholesalers, and you may have heard these words used, the MGAs. They're managing general agencies that have Lloyd's pens. They also have different domestic markets that are not usually a strata market. It'll be the mutual companies and others that will add capacity in at that level, plus some Lloyd's capacity to try and fill the whole line, they call it. Then there's cover holders that can write the whole thing. They are direct cover writers. There's a few of us around. Seafirst has been very fortunate with that. I'm just telling you that because that's where we've strictly, and why we've come out of the weeds, as people will say, well, where did you come from? Well, we've been around for 40 years doing this, but over the 40 years time, we've just earned more and more cover holder capacity. That's why you see us more. Then you have this last part, is that these cover holders have similar contracts with the same Lloyd's syndicates and markets. So that is why you run into situations where you hear, oh, Megson's is on that one already, so we can't quote, or Waypoint is on that one, so we cannot quote. I'm just trying to think of some examples. It could be Western Financial, it could be Coast Capital at the time, Hub, depending on in years past what their Lloyd's pen was. And you'd see syndicates, and syndicates are insurance companies that have been approved by Lloyd's of London to write business in Canada. There's about 200 in total, but there's only certain ones that play in the property market in Western Canada. So that is why not all brokers can get quotes all the time, because one, a domestic market that they use may already be on that building or risk. Same thing with the Lloyd's syndicate. So each time, that's why they're always asking, meaning brokers will ask, oh, who are you writing with? Or can I see your coverage summary? We already know on the back end what their relationships are, because everybody is trying to be very careful to also protect the insurance companies, because those insurance companies, if their own product is being sold higher or lower, different deductibles, everything else, they'll start to pull out. They want consistency, they want fairness for the consumer, and that's what that is all about. Because what happens is you'll see different markets, they call it blowing up the market, overline. You'll hear, oh, they underpriced the market. And what happens there is that soon as that starts to happen too often and losses are greater than the premiums coming in, the Lloyd syndicates, they decide to start pulling out and saying, sorry, we need to make enough money to cover losses, but if we're losing 200%, we're now not in a financial position to be able to cover other losses, and the reinsurance becomes expensive. So there's so much more in here, and I hope I haven't gone too far in the weeds. So getting multiple quotes, yes or no? This is the question, because how do you trust those that you're dealing with? Especially, they're just taking your money. That's what it feels like. I was a business owner for many years, and we still have businesses. I pay a lot of insurances on our farm, and I was a president of Strata in downtown Victoria. Believe me, I know your pain. But the one thing is learning and listening to what that other broker is saying. If they start comparing, oh, they don't have this coverage because it's you need this coverage, you need that coverage, and there are things you look at and go, is it property, is it liability, is it directors and officers? Once you get beyond that, what are the reason why you buy insurance is for claims. So yes, there's some of the frills that are offered out there, legal expense, crime coverage, very different in BC than other provinces, but crime coverage. You have cyber is something that's growing all the time, volunteer workers. But beyond that, we're starting to see a lot of coverages come in that are marketing, more marketing ploys than they are coverages, because you have to really read the wordings. We're seeing coverages come in now that are covering loss for unit owners. And we're also seeing other ones where they're saying, oh, well, if we can just get the loss assessment for the earthquake or the flooding or the water damage or sewer just built into it. Well, if you're a homeowner, your deductible is your deductible. As a strata corporation, your coverage is your coverage, your deductibles are your deductibles. Yes, there are unit owners coverages available to purchase by the unit owners to help with deductibles and to assist with situations. But it doesn't make a lot of sense to a lot of the insurance industry, while all of a sudden we're seeing unit owners coverages starting to creep into strata coverages. It's causing confusion, and it's also causing some situations where, again, markets are going to start leaving because their intention is not to also cover the deductible that they've put onto this, because that's how their capacity and reinsurance has been put together. So when you're looking at the current market conditions right now, and you're finding a brokerage or insurance, the things you really got to look at is, what is your total insurable value? If you're under 15 million, it's a lot easier to find a quote. If you're between 15 and 25 million, you now have probably cut your choices by half. There's probably 6 places you'd be able to buy insurance at that point. Over 25 million, you're now down to maybe 4. And over 60 million, you're down to probably 3. And in that, though, those 3 and 4 and 6 all are going to the same markets. So yes, trying to find 1, 2, or 3 quotes is very difficult, but you have to know who you're actually dealing with and be able to be very honest with them, because premium is the result of capacity and premium is the result of your risk, and that comes down to location. So what is the FUS, the Fire Underwriter Survey codes? So is there one road in, one road out? Volunteer fire? Is it maybe not even volunteer fire? Do you have any fire services at all? Earthquake, and then of course flood. Flood's been something that's been coming up more and more. The next one is building type and height. There's a lot of appetite for townhouses, and there's a lot of appetite for 2 stories and under. 3 stories and under, not so bad. 4, now you're starting to reduce your opportunities. Above 4, again, now we're hitting these same areas of, now you only have 2 to 4 options. As soon as you're over 6 to 8 stories, now you're down to maybe 2 options that are really aggressive in that area. Other than that, finding coverage is getting more difficult. Then you have liability risks. When they're now, especially in a lot of these areas, they're increasing density in areas where there's a lot more traffic. So what is the liability risk to the unit owners where you're near busy roadways? You have parking lots being used by commercial units as well as residential, plus those that will try and park there even though they're not allowed to because they don't want to pay for parking. How that area is being treated and maintained, as well as internally in your strata with the CRT and HRT, Human Rights Tribunal and Civil Rights Tribunal. There's many more liability risks coming up because of the age differences in stratas. And you're seeing a lot of people not having the same, they have different lifestyles, they have indifferences. You're running a business together, but at the same time, there's tenants and everything else coming on. So of course, there's a lot of troubled waters and those liabilities and what your exposures are. So a lot of insurers are looking at that as well as how much do they really want to deal with directors and officers or commercial general liability, which is property damage and bodily injury situations. That is what we've been navigating lately, is the directors and officers side is becoming more and more complicated. Then you have claims history. Claims history, we have a lot of domestic insurers that don't want to see any claims at all. Or they'll say, we will not insure a new building. We have to wait until it's 3 years old so we can see if it works out its kinks. Then you also have those that, once they've had 1 or 2 maintenance driven claims, there's less opportunity, it becomes more difficult. So you're seeing deductibles rise because they're called they call them nuisance claims. So when it's maintenance or human cause, we would say, just by making a mistake or maybe not understanding that you probably shouldn't put dishwashing soap into a dishwasher, and it happens often. Those are things that obviously are fed through from property managers and stratas to how to best use your appliances in your homes and be very aware of where water shutoffs are and broken toilets, or if you have multi-level, how that affects so many different levels. But insurance is for claims, and it's very important is that we sell insurance for claims, sudden and accidental, they happen. So please don't be afraid that if you have a claim, worrying about that it's going to affect your insurability. It depends what the reason was, but at the same time, we need to know because we want to help. And that's a big part of what we do at Seafirst Insurance is helping with that risk management side. I can tell you, we had over 200 claims during January freezing. And if out of all of those, there might be 24 that there's maybe an issue because they decided not to turn the heat on, and that was their choice. So their deductibles may change because of that. When you have a second freezing and you don't turn heat on, that's when now you're probably going to have, that's air. That's not a sudden and accidental. You knew that was going to happen, is what the adjusters will say. So it's really important to look at that side of it. So that leads us into environmental and location of risk. So freezing, it has been happening. Heat has been happening. Rain has been happening. So what do we do? And wind as well. So people ask us about earthquake zones and what does that mean? So it's ever changing. The deductibles are. Because capacity is reduced, the only way you can increase capacity is by increasing the share of those that are being insured. So, excuse me, in Victoria, for instance, James Bay, you're probably going to see 20% deductible now because that is an area where they expect a lot of damage if there was an earthquake. In heading towards Saanich, we're seeing 15%. And then heading out towards the peninsula, it's strange, but it is geographically pinpointed. So we're seeing some different deductibles in those areas. And as we work up island, you can see the different colors on this drawing or in this image, heading Duncan north to past Courtney and Campbell River. they called it Zone 11, that whole area, all the way to Port Alberni, or to Port Hardy, sorry. And that area has 10% deductible on average, we're seeing right now. Head over to Vancouver, we're seeing 20%, 15% to the Fraser Valley, and then 10% going into the Okanagan. So obviously I just covered that there. So what's happening is the insurers are moving what's called aggregate and capacity. And aggregate means what is the total insurable values that they have in regions. And they watch this very closely. Every cover holder, every insurer, and every wholesaler gets a certain amount of aggregate they're allowed to use in the different regions. And that's how we manage our ability to insure or not insure. But the other factor of bring into that is that rebuilding costs have gone up so high that the aggregate that they were releasing the last 2 years was not enough to cover for inflation. So of course you saw people coming, you heard, oh, we need to come off risk, or oh, we need to find another insurer to take a line on your insurance. Well, that's because they didn't have enough aggregate to fill and also keep up to inflation. We talk about earthquake and responsibility to the unit and how earthquake deductible has put a lot of pressures on unit owners, and how do you find the loss assessment coverage for earthquake deductible. The problem is that the insurers on the building are pretty much the insurers of the unit owners. So they're looking at saying, all we're doing is insuring our own deductibles. What do we do? So that plays another factor into the capacity, is they're really watching how many buildings they're insuring and what their actual impact is of the number of units that they're also insuring in those same buildings. So they look at postal codes and addresses and everything else, and they measure it out. That's how it works. Different people pay different prices based on many things, and one of them is capacity and comfort. So when you're working out the actual earthquake deductible, I thought I'd put this up because I do get asked very often, probably half a dozen times a week. So for the unit owner, it's the building value times the earthquake deductible times the unit entitlement, which gives you your unit's earthquake assessment value. So the example I used was 5 million at 15%, so 750,000 strata earthquake deductible. If one particular unit was 0.0423%, their share of the 750,000 would be 31,725. So it's simple math. So I'm going to move into flood next. The reason why I'm talking about flood is that flood and water damage are quite commonly mistaken in what the two are when we get questions. So if a sink overflows and the drain is plugged, that's a sewer backup because it was the sewer portion that failed. If a line breaks on a toilet, hose line, or on a washing machine or dishwasher or fridge, that's water damage. Or drill a hole into the wall and the copper line breaks or the sprinkler breaks, that's all water damage. Flood itself, and why I wanted to also bring this up, because it's always asked around tidal waves as well. So this is our flood extension wording at Seafirst. Not all are the same, so you got to make sure you do read them. So for the purpose of the extension, flood shall mean the rising of, the breaking out of, or the overflow of any body of water, whether natural or man-made, and includes waves, tides, and tidal waves. So exclusions in that, of course, are sewers, sumps, septic tanks, and drains. Water below the surface that percolates up is not included in that. So seeping through sidewalks, foundations, that portion that's leakage and seepage. And then any of the following perils where not caused or attributed by flood, fire, explosion, smoke, leakage from fire protective equipment, or leakage from a water main, theft, riot, vandalism, or malicious damage. Those are all covered in different areas. So leakage from a fire protective equipment, that is water damage. Types of floods. So tidal, caused by oceans and seas, tsunamis, groundwater, water rises. The reason why I want to put this is because sometimes there's words used in insurance that can be confusing, but just want to be very clear, especially for those that potentially live in an area where you're near a river or lake or stream where there has been problems. And obviously during that rainfall from November 2022, there were some big problems then, of course. So was it pluvial or fluvial? So tsunamis, of course, the one that everybody knows about is the one that happened in Japan. This is something that they worry about along the coast of Vancouver Island. So Ucluelet, Tofino area, Port Alberni. There's a lot of concern and very difficult to find some flood capacity there. So it costs a little bit more to insure. When you're looking at pluvial flooding, so atmospheric river, we all saw that or experienced it. And then fluvial flooding is when there's runoff, so not necessarily from the rain, but be from melt off. We see it Red River more so than anything. This was the biggest flood that we ever had in 1948, the Fraser River. They were worried that this was going to happen the last time, even with the atmospheric river that occurred. But for some reason, all of the upstream that spread out in the amount of debris and the ability to stop it, that's where it caused the most amount of damage. Next one, that's so when we met with all the underwriters in London in the fall, they were very curious about wildfire and how stratas were starting to be built in rural areas, and that was their concern. So how we underwrite on this in the wildfire area is we look at wind patterns, we look at the source, and we also look at the structure itself and the fuel. So what fuel is there? So in the wildfires over the previous 10 years, we get all this data that's provided to us from BC Forest Services. And we see the number of fires. It looks like all of BC's on fire. That's loading. That's just what is the actual threat. That's not what's on fire. But on average, we see 1,300 fires, 3,400 kilometers of forest burnt, and 265 million spent on fighting forest fires. 60% which are caused by human, 40% by lightning, and then the other are unknown. So we've seen a lot more now moving along with fire. What is FireSmart? What does that mean? We get a lot of calls asking us about FireSmart, and they say, oh, if we do it, will we get a discount? The insurance companies come back to us and said, if they're not doing it, they're going to get charged a surcharge. Right now, we're thinking that everybody cares enough about their buildings that they're going to want to do this themselves. We're not going to give a discount if you do it. This is just to be able to get insurance, especially in the Okanagan and some of the more rural areas. So clean and maintain gutters, roofs, decks, balconies, keep debris and combustible items off deck and surrounding the exterior, fuel of any kind. So propane tanks and firewood. This is part you can get graded on this. I don't know how many of you have been through this already. And then, of course, maintain sheds and other structures to the same level as your home. And home meaning townhouses, strata buildings, whatever they may be. So the underwriters themselves, when they're looking at fires, fire cannot be excluded. And we get those questions as well. But what will happen is that if there is a fire within 50 kilometers as the crow flies in a directional, you will not be able to get a quote. That's what underwriters are at right now. Basically, it's hard to find insurance when it's already on fire. But if you have insurance, they cannot exclude fire. So we've seen some of the brokers in other areas offering a wildfire deductible that's higher. I'm not too certain where that's coming from, but fire is fire. So determine if the account has a wildfire risk. Well, obviously, if you have trees close to you, every location that has trees close to you could be a wildfire risk, especially for how dry it's been over these past years. But what they're trying to do is reduce the amount of debris on the forest floor. So I don't know how many of you are familiar with Dean Park, for instance, which is out on the peninsula. They're spending money that was provided by the provincial government in that area. They're slash burning, they're cleaning up, they're dragging old logs and boughs and everything out the forest floor to try and reduce that risk. The rating for fire risk is all based off of the FUS codes. So the fire underwriter survey, based on what is your rating. So if you are one road in, one road out, very difficult to find insurance right now. If you are one road in, one road out with on-site fire all year long, you have a much better opportunity of getting coverage. This is what they're looking at now as seasonal fire coverage is not going to be sufficient. So we're seeing quite a few stratas, even up on, say, Mount Washington, where it's seasonal, or up, like, how do they have actual true improvement on their fire underwriting survey? There's a lot of effort and cost that go into that. But right now, we have not seen any changes in the appetite or the ratings up on Mount Washington. They are about 3 to 4 times the price for insurance up at Mount Washington than it is in Courtenay, as an example. And then deductibles, that's what I was just talking about. We're not seeing a big difference in deductibles right now. All loss for fire, lightning, all those types of coverages. Okay, so what is insurance for? Insurance is a transfer of risk of property and liability that an insurer will take on that is for sudden and accidental occurrences. It is not intended as a warranty product or a maintenance coverage. And we run into that a lot, where we will have, what age is your hot water tank? Oh, what does that matter? We'll replace it when it breaks. Okay. That's a problem, because the intention of insurance is only to cover the resulting damage. But if we know that's going to happen, we have to tell the insurance company that, and the insurance company will say, I'm sorry, we're not going to offer coverage, or we'll have a $250,000 water deductible. Because if you're willing to take the risk for a loss, then you're willing to pay for it. So that's something we're seeing more and more now. We're seeing a lot of questions around, oh, well, the roof, will replace it when it fails. Well, you're seeing roof warranties now. So the cost of insurance and deductibles have risen because of many factors: capacity, which we've talked a lot about, environmental factors, and catastrophic risks. Rebuilding costs have been the major contributor to the increase. So for us, we have seen flat rates over the last 3 years. We have not seen an increase in rate overall as an average. The odd places increased based on the catastrophic risk, but we have not seen for the normal, urban, you name it, it's got great fire coverage. Earthquake deductibles have changed, but not the actual rates have not changed. Rebuilding costs have skyrocketed. So we do a lot of calculations each year to explain how that's changed. And then the other thing that has changed a little bit is the liability portion, but that's been at a fraction of the cost. So if it's gone up $150 and you have a $50,000 premium, you don't really notice it. But if you have a $5,000 premium, $150, you do notice it. So, but those deductibles, or sorry, those premiums for directors and officers and commercial general liability have changed about 3% over the last 3 years. And then the last part that we're seeing now is the aging of buildings and building bylaw changes for rebuilding. Those two things factored in with rebuilding costs and material costs and labor. I've seen over the course of the last 3 years, I've seen an increase of 21 to 27% change in a building recost on our appraisal from the year prior, just based on building bylaw changes alone in a region. So what can you do? We're always asked, how can we help keep pricing down? How can we help keep rating down? That's what we can help, is rating. The pricing, there's a whole bunch of influence there that we have no control over, such as the inflation, the cost of labor, cost of materials, different building bylaws. I don't know if you've seen the new building codes coming out, but all new multi-residential buildings, every unit is going to be needed to be built for access. That means that you're going to see 20% bigger hallways, 20% bigger rooms. If your neighbor has disabilities and is in, say, in a wheelchair, they need equal access into any of the neighboring locations as well. That's going to be coming into hotels too. So there again, as much as they want to reduce the cost of purchasing a home and rentals, they're increasing the sizes, so that's going to become more expensive. We're trying to figure out how we can assist with that, and what does that mean with bylaws, and how many different cities are going to bring that in to the requirement if there's a total loss, and what does the replacement look like on an appraisal? Do they take that into accountability? We won't know for the next probably year and a half. But the other thing that we can look at, though, is depreciation reports. This is the number one area that insurers love to hear good stories about how well prepared financially, strategically planned, as well as risk management, upgrades and maintenance are done to a building. And share everything with your broker. If you repainted lines, if you had the storm drains cleaned out, if you have someone who goes up and cleans, if you have a flat roof and you have someone that once a month during from the end of summer to spring goes up there and cleans the drains, let us know as brokers, because we put that into the file. That matters. Every type of inspection you have done, a roof inspection yearly, you never know what can happen, especially if you have trees around, something stabs through the roof. Electrical inspections in a timely manner, plumbing inspections, anything just to stay on top of it. No different as if you owned your own home and it was one home versus shared business with multiple individuals. And then you want to be able to demonstrate that you do that with long-term stability and proactive approach to the building maintenance, which will put your building in the best light and the best position for risk assessment and for rating and insurance. The other thing is having a very clear communication between strata council responsibility and unit owner's responsibility during claims, during maintenance, whatever it may be. Make sure you're not contravening the Strata Act. Make sure that it's a strata lawyer that you're dealing with that helps you with bylaws if you are doing that. Ensure your strata is meeting regulatory requirements, and that building inspection reports and recommendations are reflected in the maintenance programs. Repair plan, as I had said earlier, anything that may pose a risk, such as roofing, water lines, electrical, and drainage systems. If you stay on top of that, insurance companies love it. It's a great story to tell.
Okay, well, thank you very much to Steve Pearce from Seafirst Insurance for being our guest speaker today. And thank you very much for joining us.
Thank you very much, all. Take care. Thanks, Wendy.